Um, it should be live now. You guys can see the screen should be okay now. All right, good to go. So like I said, we'll be looking at selling MarketSpy signals exclusively, and we will assume that you have been warned about selling in general, how shorting is for the select few. Many people fail. They don't know when to take profit. Short moves are very rapid, short-lived, and they don't last as long unless it's a bear market. In your settings on MarketSpy Armageddon, you will enable these 2 points here, MAX7 prep signals and bear markets only. Even though we're not in a bear market, I want you to have this on. Pause the screen and take a look at these settings here, what I have activated, and just follow along. So this is specifically for those that are interested in shorting and are, excuse me, but I'll be blunt, are falling into the traps of the exchange that advertises shorting as the reason that you have signed up. Because the slogan here is, doesn't matter if Bitcoin goes up or down, you can still make money. The truth is, there's more money to be made, and it's safer if you're long only, especially during these market conditions that we're in right now. But nevertheless, we're going to look at the signals right now, and we'll cover 4 strategies. One of them will be a punch out strategy for short sellers. Second strategy will be an inverse market enemy setup. The third strategy is going to be MAX7 exhaustion points, and the fourth strategy is going to be trend continuation. So let's start with number 1. You want to have your Armageddon on. First rule to remember is that you never sell into support. If you have logical or any other form of support, be it dynamic in the form of a moving average and whatnot, you don't want to be selling into that. Understand that most signals on all indicators are lagging. There is no leading indicator except for price. Price is king. And so your journey begins by looking at market structure in general and identifying pivot points. A pivot point is an area where we've had a bounce. You see this baseline over here? And we're in the green. That's a pivot point, okay? For an extended, prolonged period of time, if you're in the green, you're looking at a pivot. You know that eventually this thing is going to come to an end and we're going to have a moment of relaxation here, okay? We're going to ease off and consolidate, or correct as it's known. So first things first, please check your flags to understand how deep into the trend are you here and how likely it is that things are going to come to a little pause. For me, it's the 4 flags in a very strong uptrend. So when I see 1, 2, 3, 4 typically followed by a red flag, that is telling me that we might be looking at short signals that are now more solid. For example, if you have a diamond here, which is a short signal, yellow X, which is a short signal, and a red dot, MAX7, which is a short signal, you want to skip or buy these kind of dips, because what happens is that you're inside of an uptrend, and your long-term trend flow is the thing that you look at always to see what is going to happen in the near future. Now, long-term trend flow has that name because it will last a little bit. It will last a little bit. So when you have a short signal here, it is likely that it's a false alarm and you should be buying the dip. We talked about how to buy, get your entries, exits, using these signals, and why we should be buying them and ignoring the short signal when it occurs. Looks here. So first and foremost, a word of warning here for people who just like to jump on signals. Do not do that. You have been warned. MarketSpy is not a sell or buy signal as the signal comes. There's a way to execute. Welcome to trading. The markets are always ahead, one step ahead. Price is king, and you simply cannot, if you have indicators that tell you buy and sell, those are gambling indicators. Simple as that. And if you treat MarketSpy the same way, you will get burned. So understanding structure, maintaining your sanity and composure here is important. You need to have a little bit of patience. You need to understand how long it takes to execute a trade, and why you need that time reserve in order to perform the trade. So once you get a short signal, doesn't mean immediately price is going to go down, but it's showing you lots of weaknesses, and this is how we look at it. So the first sign you will have is you have your 1, 2, 3, 4 flags, and then you have a baseline reclaim. Now, baseline reclaim is the kind of thing that happens when price falls and closes below the baseline 1, which is green, that shifts to red. I think it's pretty self-explanatory here that when we go from green to red, you're in the short territory. It's very, very simple. Now, in order to confirm that it's not a hot pocket of correction, and before we go higher, we need to look at a couple of things here. Number one, we need to look at the width and the thickness of the dragon skin. The so-called dragon skin, that is basically a rename for a set of moving averages that kind of resemble the skin of a dragon. And so we assume that when it's thick and spread out, that it creates many levels of stops and buyers, as people use these to implement a variety of strategies that they can benefit from. And so we understand that when price falls into this dragon skin, it is likely that there's going to be a rebound. Even though we close below the baseline here, that does not mean that we're going short immediately at the close. What it does mean, however, is that you will, let's go over to a different chart. Let's go to Coinbase because it's clean, and so we can draw a little bit easier. So I'll use my brush tool here, and we're going to do some painting together. So like I said, you need to identify if it's an uptrend, what goes up must go down, must correct, must take a pause, must have a moment of reflection here, and the market must decide, do we go higher or we go lower. During that time, you will have an opportunity to be short, and you can extract some profit from the market by looking at this. So we have two baselines that track price, and then what happens is that we enter this territory between baseline 2 and baseline 1, and we start ranging in there. During this range, you can make a decision and execute a short signal based on the diamonds, pyramids, yellow X's, and maybe red flags. So you have 1, 2, 3, 4 flags. That's your signal that we have had basically 4 momentum waves, and these waves don't go on forever. So basic logic tells us that after 4 or 3 or 5 waves, price will exhaust, because at a time frame like 2 hours, for example, that's a lot of going up. Okay, so we're going to take a little pause, take a little breather. Now you get a short signal show up here, price drops and immediately rebounds, because the first signal is always, it's not the strongest. It's not a continuation signal, it's an initiation signal. So how you execute this is simple. Once you have a baseline reclaim, price will fall, produce a bearish signal, rebound, go up against the baseline, and this is your entry point. So signal is here, short signal confirmation is here, price rebound, your entry is here. Now, how you take profit is up to you. We have covered many strategies here. That's a whole different topic altogether. This is risk management, position management, money management territory. And you have to learn those things and not complain if price doesn't immediately produce the desired results that you want. So your entry is here. Price dips back towards this range. It chops around. It has given you plenty of time to take profit. This is a $1,000 range. So if you're not taking profit here, there is something wrong with your approach to trading, period. You do not understand the energy of ATR. Okay, here's another short signal. You get a trigger, okay, on the diamond, the yellow X, the pyramids. You're still inside the dragon skin. For scalpers, risk to reward ratio, the math here is simple. A dip like this into the thickness of the dragon skin will produce a rebound. As long as you're in the green, long-term trend flow. That's very important. Long-term trend flow does not care for small dips like that. But we're seeing weakness in price. We're seeing that baseline now dominates. The reason this is called Armageddon is because when it starts to hail fire from above, from the sky, it will suppress price. It dominates price. When price is above Armageddon, price dominates it, and the signals are buy signals. Now let's take a look here. So we have a follow-up. So you had your short here, you took profit here, you have another short signal, price goes up, hits the baseline, you're short again on the baseline. In professional trading, we need to have a series of confirmations. If you have a short signal here, price needs to come back to that area or about half of there where your entry is in order for it to go lower and go down. If you're able to identify that kind of the fading out of momentum to the upside. Now the red flag means that this is the first candle on momentum wave that closed below baseline. It's a better sign. Do you go short here with a market order immediately? No. You wait for a signal to confirm. You have your short signal here, price goes up towards the baseline. You already know about what the diamonds here mean. When there's an opening, these two candles are your short candles. You go short here, price moves away. Typically with MarketSpy, you're put in profit immediately 3 to 5 candles later. If nothing happens, you should get out and close the position. In this case, we went short, price dropped, and you have a yellow X on this. This is your confirmation to hold, and it is likely that this will continue falling. Your stop is placed just above your entry or on the highest of the pivot. Now you're assuming all these signals are correct for the short side, and they have established that this pivot over here is going to be an untouchable area. So you can size according to your stop being placed here or here. It will be different for everybody that trades these signals. So in order to execute these stops, that's your personal preference. You know, if you luck out and the market doesn't take you out, good to go. If it comes back and has one spike here and goes down, well, welcome to trading. Like I said, this is something that you have to deal with. Nothing is perfect. Now, this pyramid here closing below baselines, all of them, as a matter of fact. As you can see, the bounce here is very hard. The bounce here is okay. The bounce here gets smaller and smaller, and finally this pyramid is on the red candle with a yellow X below the baseline. Your short entry is here, your short entry is here, and your short entry was here at the retest of the baseline only. Before going down, price will go up and allow you to enter a trade, enter a position. This is what you're looking for. You're not looking to go short where the signal appears, okay? And you're looking to short after an extensive run up, not a tiny little trend up and then the first little correction you're shorting that right away. No. So you enter here, price goes down. When you get a green square, close your position, because this means that price will stop dumping, most likely, especially if it's ranging, and you'll need to reassess what's happening. Always look at your momentum, because the rate of acceleration of this dump, if it's slow and steady, the momentum will kind of outrun it a little bit. And even though price is not moving, you can have momentum that's going down while price is going sideways. So as soon as it reaches these oversold levels, you need to consider taking profit, even if price didn't really dump, but just kind of went a few candles down and then caused this momentum to be oversold. So it just went horizontally. And as you can see here, this would have been a great take profit area. So if you're short from here and you're exiting somewhere around here, you don't even have to wait for the signal if you're using our system based on ATR and for a sign of support. This is a $2,000 drop. You're in profit for the day. You're good to go. You can go and take a swimming lesson or something. Go and enjoy life. Now we have another retest of the baseline here with a little short pyramid. You can go into a short trade here, but understand that you need to look at the delta to confirm. If delta is curving down and you have a short signal in the red, you can go ahead and get into a short at the retest. Now the retest here would be this baseline. Okay, this is a bad entry, and if your stop is here, you would have been shaken out of this trade. Okay, part of life. Moving on, we have an aggressive baseline reclaim over here. All right, this is a ranging trading environment right now. Look at the purple line over here just to give you a little bit of understanding where we are. We go sideways, which means price doesn't want to continue going up. 1, 2, 3, 4, 5 candles, and we're not going up. Wait for a short signal. Short signal comes in. This is a MAG7. Now, MAG7 is printing these yellow dots over here. VVS is showing you that there's pressure applied to these candles. You have a diamond here, and you have a short pyramid that closed below all baselines. It's a short signal. How do we execute? We wait for this to go up towards the baselines so you can scale. Your stop is placed on the pivot high, or the one over here, and your entry is anywhere here in the baseline. So this goes up, you short the baseline, it goes up, down, goes up, spikes up. All these pyramids here are bearish signals below baseline. The cluster of these showing you an extreme strength that is developing below baselines. For us, that means that price is likely to go lower. Price goes down, 2-3 candles later, you're taking profit. How do you know there's no continuation down? You look at the candles, 1, 2, 3, 4, 5, and price is not moving while at the same time producing wicks. You're free to close your trade, having your entry here down to here. That's another $2,000 move down. Now, recovery. Okay, you already know how to long and what to look for. Is the inverse of all this. Here's a hot pocket that will prompt you to go short, but ultimately make you fail. And this is where the difference between these signals and these signals happen. So recovery over here, long-term trend flow is telling you that we're going higher. You get a short signal over here, right? You get a short signal. Price goes up and it's in the dragon skin. There's baseline support. Long-term trend flow is nice and thick. And a tiny little bit of red here, nothing to worry about. These are not short signals. Sometimes you have to wait. However, if you did go short, you would go short on the retest of the baseline. You would go ahead and place your stop right here, the pivot high. Okay, price goes up, doesn't touch your stop, goes back down a little bit, gets support by dragon skin, goes back up, and now you understand that your entry 1, 2, 3, 4, 5 is not moving. It's not moving down. You take a little bit of profit in this region away from your entry and you call it a day. Taking profit is extremely important. This is a $500 move if you were to go short on the baseline here and exit anywhere here 1 candle later. Good if you did that, because right after that we had a pump. Okay, and this is what we talk about when we talk about the dragon skin and the baseline supports on the pyramids. Long-term thick trend flow, you want to be buying these to go up. Now, because away from this pivot, it's been a while, so we're looking from here to here. That's about 6 days of pumping. Now, what do you think is going to happen after 6 days of an uptrend once you get a short signal? Well, I'll show you. You have flags 1, 2, 3, 4. This is a 2-hour time frame. You have a flag. You get a short signal over here. What do? First of all, you buy this short signal because it's dropping in the dragon skin into equilibrium zone 2 in the green trend flow, still intact. You buy, it goes up, you take profit at the first sign of resistance, you get a second signal over here, bearish signal because we're below the baseline. Price goes up, it is now time to go short. Ignore the MAG7 here, it's happening at the tail end after the fact 6 days later. You're not looking to long this by any logic. So reasonably so, we look here and our entry is in EQ1. Equilibrium 1 serves as a place where sellers and buyers are found. So according to that knowledge, you're looking to go short right here in this equilibrium zone 2 with your stop placed over here. This is your risk and these baseline is your reward. So it's 2 to 1 right here. You take profit at the closure of these candles. As a matter of fact, 1, 2, 3, price pumping and nothing to worry about. You can add an equilibrium zone. You're below the purple line. Does that make sense? You're below the purple line. This is applying more pressure on price. We're going down. Do I need to mention this yellow pyramid and the red dot below all baselines? I don't think so. Do I need to mention that we have a green dot, pre-order dot, post pyramid? Not at, not before, but post, which is also a bearish sign for us. I don't think so. So this is your basic trade execution technique for a reversal setup on the Armageddon short signals over here that they print. Now we're going to look at a variety of ways to do this. Way number 2. Armageddon gives us these bearish signals and bullish signals inside of equilibrium zones, depending on where we are, above baselines or below baselines, depending if we're in the green flow or the red flow. And so we're going to now look at different strategies to actually get into one of these trades. So strategy number 2, not using the baselines as your entry points where there's no diamond and the ATR ratio is in your favor. Let's look at another strategy, which is called the punch out. Punch out uses a specific Fibonacci trend tool, extension tool, and it looks something like this. Pause the screen and take a look at the settings here. This is how you want it to be set up. Okay. Using the tool, we will utilize simply the color of the green, white, and red candles, which are sort of like a simulation of Elliott wave trend candles, and this is how it's done. You will use your Fibonacci trend-based extension tool, and you'll look at the first red candle with a bearish signal on it. Not white candles, red candle only. Not white candles, red candle only. And this is what you're going to do. After an extensive move up only, not sideways consolidation like this where it's been selling and now you want to keep selling here just because they're red candles, but we have been selling from here. No, you want to have a set of green candles, transitional white candles, and then bam, your red candle. Now, from the top of this candle, you will click on the Fibonacci extension tool, go down to the low of the candle, and bring it right back up to the top of that candle. So is the top, the high, the low, back to the high. And what you will see is it will print something like this. It will give you a minus 0.5 level and it will give you 1.5 level right here. What we do is we want to see if this first initial red candle is able to produce consecutive candles that can close above 0.5, 1.5 Fibonacci level. Now let's see if that's the case here. As you can see, we have 1, 2, 3 candles that close below the 1.5 level right here. Okay, this is your signal to go short, but not at the bottom. What you do next is you cast a ladder from here all the way up to 0.5, where you will have your stop ready. So you will have a ladder that will pick up an average of contracts from here to here, like this. It will start going up while giving you a fill. So your average price will be whatever, somewhere around here, and your stop will be placed at minus 0.5 right here. So 0.5 fib points or whatever the calculation is away from the high of this bearish candle. Now once you get your fill, price will print more bearish signals and start moving away in your direction. Now you have an average fill and it continues to fall and you're in good profit. This is an easy example, but be warned, you will get wrecked in consolidations if you don't understand market structure. I have specifically choosing this because many people look at these moves and they think they're going to get them every day. You're not. This is a one-time event that you're witnessing on Bitcoin right now. After a long time coming, we're now finally starting to correct. So you have to understand what you're looking at. Don't be tempted just because prices have been falling and you think this is going to be the case for the rest of the year now. Could be, but just a I like to warn people anyways, just in case. We all need a reminder once in a while. So this purple line here will show you that, yeah, we're being suppressed and we're not going higher than that. The purple line measures volume, so it's important to understand that the buy volume here is nowhere to be found, and the majority of red candles here represent at the volume bars that sellers are in control. You can just scan this quickly. Even this rise over here, this was a place for them to go short. There are many sellers starting from here. This overextension, this is where fools get trapped. Okay, longing. We're selling on green candles and we're buying the red candles. Now, this is the strategy right here, right? This is called punch out. So price goes down, punches out from the 1.5 level, confirms as your short signal. You have two options. You can go to Fibonacci level 1 to go short, or Fibonacci level entry at the high of the candle to go short, but your stop is always sitting here. Or you do it like I do it and you ladder in. Let's take a look at this example here. What would happen if you wanted to use punch out using this strategy? So you're thinking this is going to continue. So you get your candle. When you get a red candle, you start measuring it. Okay, you start measuring the Fibonacci tool. You go from low to high, back to, sorry, this is for a long setup. Let me just do it again. So from high to low and back to high. Okay, so couple of things here right off the bat. Couple of things here. Number one, when you have a red candle, right, and it does not produce follow-through candles that do a punch out, this is an invalidated signal. If a white candle or green candle shows up, that's it. The strategy approach, the punch out, is canceled. It's not producing enough candles for you to go short. Okay, so that is canceled out. This previous candle over here, let's measure that for our strategy. We go high of the candle, low of the candle, back to high of the candle at 0. So our 0 line must be at the high. We have a punch out set up right here. Okay, look what happens. Price punches out, doesn't go back up because we have a lot of pressure here, and as a matter of fact, this yellow X is pushing it, and so you scale in at the punch out, and your only fill area, what you're gonna get is this little candle that's going to pick up a tiny bit of contracts, and that's all you're gonna get. You're not gonna have a retrace. That's not always the case. It's just an approach and then go down. So in this case, sucks because you're now with a very small batch of contracts and price starts moving and there's no reason to chase it now. As soon as it goes up and shows you a white candle, that's it. This trade is no longer valid for this particular strategy. Punch out, it's invalidated, and you close your fib level, you take profit and call it a day. You look for the next setup, whether it be a long setup or a short setup. Okay, let's go for so we have covered a reversal strategy on market enemy using the pyramids. Now we will also do something a little different where you have an inverted chart for the market enemy and you look at it like this. You have a baseline reclaim, you have a retest, right, and you have a pyramid over here. Now when the pyramid shows up, there are no candles here, but you are going to take a box, look at the pyramid, right? Take a box, look where the pyramid showed up, go to the previous wicks over here, and you're going to scale from here, from the wick where the pyramid showed up, the first drop, so your pivot, all the way down to the previous pivot in the range. This box is going to be your short box, where you will get your entry in and go short. Okay. So market enemy requires us to print something like this, get in there, supported by the baseline. You have many short signals within this box that you can trade. Same goes for here. You have these pyramids over here coming up, right? And what you can do is, once they print, you will go from, well, the pivot is too far away. But you have your box right here, which if you wait for the setup, we come back up. Now look how crazy it got run. You got filled, but you still came out in profit, and price went inside of this range over here and gave you a chance to exit. So this is an inverse market enemy setup, but remember, we're in a bullish structure, and so that is not recommended, because if price reverses and decides to continue going up, good luck. That's what you get for being short. So pyramids, punch out, and now we will do one more strategy where we have a simple MAX7 setup. Now, today in Discord, we had someone post a signal and say, this is my MAX7, and they said something like, to me, it's a MAX7. Well, these strategies are pretty fixed. If to you it's a MAX7, and you haven't watched the video on MAX7, and you somehow make your own MAX7, then by all means trade what MAX7 is to you. What to us and to the algorithm, what a MAX7 looks like is slightly different. So let's take a look at this green red dot over here. Is this a MAX7 just because there's a crack in the ceiling of the long-term trend flow? No, we already talked about this just now. It is not a MAX7. MAX7 happens at the tail end of an uptrend. So we go up, 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 and we get a MAX7 setup. Yeah, you're getting a good continuation signal. How do we trade MAX7s that go up? Okay, how do we treat MAX7? So here's a setup. Here's a MAX7 setup. The way we do it is when we have one that prints, let's find one somewhere at the bottom if we're able to. So basically, you'll have a print of a MAX7. You'll have an immediate retrace, okay, to half a candle, even lower at the previous low over here. Let's get my brush in here. So MAX7 prints, price goes down, and then you go long. All right. MAX7 over here prints, price goes sideways or down, and then you go long. Okay. It's fishing, so not everyone is a great fisherman. So if you don't get your entry the way you want it, just because the signal is there, but it somehow didn't exceed your expectation, didn't give you an entry, don't blame the algorithm, because that is on you. That is years of practice. That is years of patience executing these trades, looking at them. It's not that the market owes us anything at any time. So we don't care about that. But what we do care about is when we get a MAX7 setup like this, we want to understand that in order to execute on the signal, as always, it prints, there's a follow through, it retraces. Okay, MAX7s are very powerful, and when price retraces, you're looking at HC. HC on this channel is the half candle theory. Now, it's loosely mentioned that it's half candle, but it's actually pivot to low. It doesn't have to. You have to understand that this, looking at a 2-hour time frame here, on the daily or 4 hours, that's half candle. So your entry is at HC over here on the short MAX7 signal. This is an inverted chart. If you press Alt plus I on your keyboard, it will flip the chart like this. You can have fun flipping it. And sometimes this can reset your bias and give you a clearer view of what it is that you're looking at. So, and if you're HC at half a candle here, and you know this MAX7 setup is going to allow the candles to come back up, do you have the patience to sit for 22 hours for this to play out on a 2-hour chart? Well, if you want consistent results, you have to. So you get your trigger. Now you can prepare your trade, look at your targets, calculate your size, do your stops, the whole thing, the whole 9 yards. And then you execute 1 day later when your pending order gets filled on either the purple line, equilibrium zone 1, or whatever. And then you get a signal followed by another MAX7, which for those of you who were not short here, or not short here or here, you can simply wait for this to, this MAX7 goes down, it comes back up, and this is where we arrive at strategy number 4, trend continuation. Now, you know, on uptrends on MarketSpy, when we have a good baseline reclaim and a follow through, these flags are called checkpoints, are prompts to add to the position. So for people who are long from the absolute bottom pivot, this is a prompt to take profit. For people that are not long here and are late, the risk goes up, but it's a chance for them to participate in the trend. So it's a trend following system where you go long on the dip of the flag inside of the dragon skin into equilibrium zone 1. Okay, checkpoint long, checkpoint long, checkpoint long, but you can't continue doing it 1, 2, 3. You have to be very careful about that. The 4th flag in an uptrend is going to exhaust everything. The same goes for these squares. Now, the squares are the inverse of these flags. Think of them as points where when we're trending down below baselines and the square shows up, this and price starts going up, you have to train your brain. You go short on this signal, so you sell into it. You pick up a number of contracts and you sell, just like you would on these checkpoints. These green stop squares telling you that we're taking a pause, not a reversal. Sometimes it's a reversal, but most likely a pause. This pause is where you go short, meaning you let price climb up as high as possible towards equilibrium zone 1 to get the best damn entry out of anybody else, and you go short here, confirmed by the signal. You're holding this and you're untouchable basically if you follow this strategy. Here's another one, MAX7, a little bit of relaxation here. Price goes up towards the equilibrium zone 1. Try to get an entry in here somehow. The next candle puts you in absolute beast mode profit. This is a good trade, okay? If you get in and it starts moving sideways 3, 5 candles later, get out, because it is not going to continue going down. It's hesitating. Something's off. Have your spidey senses tell you something, you know, trust it. Now, we have something like this. When this happens, okay, after a while, here's another one. It goes up into the dragon skin over here, short signal, confirmed, it goes lower. Now you're inside the baseline. Be very careful about your shorts here. You have to reevaluate what is happening structurally. This is different. Here you're mostly long until you have this breakdown and you see that we're not staying above the equilibrium zone. The orange line and the green line is trending down and price is following it. And this wick over here, we drop, correct, go back, and we just can't maintain it. These candles over here telling you that we're going short. So there's no entry here. So if you were not short here, you were not long or short here. So anyways, this is the last strategy of this. Hopefully this has helped you. One thing I'd like to mention is please take a look at your VVS readings over here. The brighter the yellow, the stronger the continuation signal is short. The more choppy it is, the more likely that you're going to get knocked out from your position with a stop loss. Try to take profit as soon as you're in the green and you will do okay. This is how you execute short signals on MarketSpy, using punch out, using the trend following and market enemy pyramid signals below baselines, where your short entry is on a pump, not following the candle down. Don't get trapped, okay? It has to reverse, you go short, and then manage your position from there. Thank you very much, and I'll see you in the next video.